Something just moved, something massive. While you were checking your portfolio yesterday, while analysts were debating interest rates on television, while the media recycled the same headlines about inflation and unemployment, $2 trillion disappeared from the United States financial system. Not lost, not vaporized, relocated. I am Ken Au. Welcome to the Vault. Today, we expose the largest capital flight in modern history, and by the end, you'll know exactly where that money went and why. This isn't speculation, this is documented movement. BlackRock, the single largest asset manager on the planet, controlling over $10 trillion in global capital, just executed a coordinated reallocation so vast that most retail investors won't even notice it happened until it's already too late. Let me be clear about the scale. $2 trillion is not a rounding error. That's more than the entire GDP of Canada. That's double the market cap of Apple at its peak. That's enough money to buy every single share of Tesla, Microsoft, and Amazon combined, and still have $500 billion left over. And it moved in silence, without headlines, without panic, without your permission. The surface explanation is simple enough. BlackRock shifted exposure out of U.S. equities and into emerging markets, foreign bonds, and international infrastructure. Portfolio rebalancing, they call it. Strategic diversification. Normal operations. But you need to understand something fundamental about institutional capital. Money at this scale doesn't move on hunches. It doesn't move on sentiment. It moves on math. Cold, calculated, probability-weighted math that sees around corners you didn't even know existed. When BlackRock moves $2 trillion, they're not guessing. They're not hoping. They're responding to signals that retail investors won't see for another 6 months, signals that will only become obvious when the damage is already done. So what happened? What triggered this? The dollar weakened, not collapsed, weakened. The purchasing power of every dollar you hold dropped by roughly 3.5% over the past year when measured against a basket of global currencies. That sounds small. It isn't. For an institution managing trillions, a 3.5% currency headwind is catastrophic. Think about it this way. If you're BlackRock and you're sitting on $10 trillion in assets, a 3.5% dollar decline just vaporized $350 billion in real value. That's not a theoretical loss. That's actual purchasing power gone, deleted from the balance sheet. So what do? You move. You rotate out of dollar-denominated assets and into currencies that aren't bleeding value. You shift exposure to markets where growth is accelerating, not decelerating. You protect your clients' wealth by abandoning the sinking currency. This is where things stop making sense for most people, because on the surface, the U.S. economy looks fine. Unemployment is low, GDP is positive, corporate earnings are strong. The S&P 500 hit new highs just weeks ago. But institutions don't trade what is, they trade what's coming. And what's coming is a leadership rotation, a changing of the guard in global economic dominance. Look at the scoreboard. Last year, Germany returned 22%, Japan returned 26%, emerging markets as a whole returned nearly 30%. Meanwhile, the S&P 500 delivered 16%. Now, 16% is good. It's positive. It's better than cash. But when you're BlackRock, when you're managing pension funds and sovereign wealth accounts and retirement portfolios for millions of people, you don't get paid to deliver good. You get paid to deliver best, and best isn't in America anymore. Not right now. This is the system failure nobody wants to talk about. For decades, the United States was the undisputed champion of capital returns. If you wanted growth, you bought American stocks. If you wanted safety, you bought U.S. treasuries. If you wanted dominance, you bet on the dollar. That equation just broke. The math changed, the probabilities shifted. And BlackRock, with armies of analysts and data feeds that cost more than most people earn in a lifetime, saw it before anyone else. Here's what they saw. They saw policy risk accelerating. They saw currency pressure mounting. They saw $48 billion in foreign capital leave the United States last year alone. Not enter, leave, pack up and exit. That $48 billion isn't a number on a screen. That's real money. That's pension funds in Norway deciding they don't trust U.S. markets anymore. That's sovereign wealth funds in Singapore rotating out of treasuries. That's insurance companies in Switzerland closing their dollar positions. They saw demographics tilting. The U.S. population is aging. Baby boomers are retiring. Workforce growth is slowing. Meanwhile, places like India, Vietnam, Indonesia, these countries have young populations. Workers in their 20s, consumers just entering their spending years, economies that are doubling every decade. In India alone, the median age is 28. In the United States, it's 38. That 10-year gap is everything. Young populations work, they spend, they build, they borrow, they create economic velocity that drives GDP growth for decades. The United States is heading into a demographic winter, fewer workers supporting more retirees, slower consumption growth, lower productivity gains. It's not a crisis, it's a mathematical certainty, and BlackRock can read a population pyramid as well as anyone. They saw political uncertainty spiking. And before you think this is about Trump or Biden or left or right, Stop. This isn't politics. This is volatility. Markets hate uncertainty. It doesn't matter who's in charge. It matters that the next policy decision is unpredictable. Tariff threats, trade wars, debt ceiling drama, regulatory chaos. These aren't headlines. These are risk factors. And risk factors cost money. When Trump threatens 25% tariffs on Canada and Mexico, institutions don't care about the politics. They care about the supply chain disruptions. They care about the inflation spike. They care about the retaliatory tariffs that follow. They model the scenarios. They calculate the expected losses. And they move capital before the damage hits. So BlackRock moved. They rotated $2 trillion out of the U.S. and into markets where the trajectory is clearer, where growth is faster, where currency risk is lower. Now here's the hidden layer. This doesn't happen by accident. This isn't a single portfolio manager making a bad call. This is coordinated, institutional, strategic. BlackRock didn't just wake up one morning and decide to sell America. They prepared, they analyzed, they modeled scenarios, they ran stress tests, they war-gamed currency collapses, inflation spikes, policy shocks. They knew what was coming before the data even confirmed it. Let me walk you through how this actually works. BlackRock has over 15,000 employees. Hundreds of them are quants, data scientists, economists, strategists. They have proprietary risk models that cost hundreds of millions of dollars to build. They have access to real-time capital flow data that you and I will never see. They track currency movements. They monitor sovereign debt auctions. They analyze central bank balance sheet changes. They watch trade flows, shipping volumes, commodity prices, credit spreads. They aggregate all of this data into risk scores that tell them where capital should go next. When their models started flashing red on U.S. equities 6 months ago, they didn't panic. They didn't tweet about it. They quietly started repositioning, trimming exposure, reducing dollar risk, building positions in foreign markets before anyone else noticed. By the time the mainstream financial media starts writing articles about capital flight, BlackRock has already moved. The $2 trillion shift we're talking about today started months ago. It's been gradual, systematic, invisible to anyone who isn't watching institutional flow data. And here's what most people miss. BlackRock isn't alone. When the largest asset manager on earth starts moving, others follow. Vanguard watches, State Street watches, pension funds watch, sovereign wealth funds watch. This creates a cascade, a rotation, a stampede, because once the smart money moves, everyone else has to follow or get left behind holding depreciating assets. Think about the mechanics. If BlackRock reduces U.S. equity exposure by 10%, that's $1 trillion in selling pressure. If Vanguard follows and reduces by 5%, that's another $400 billion. If State Street, Fidelity, and the major pension funds follow, you're looking at $3 trillion to $5 trillion in coordinated selling. Who's on the other side of that trade? Who's buying? The answer is you, retail investors, 401k holders, people who don't have access to real-time capital flow data. People who are still being told that stocks only go up, that America always wins, that diversification means owning 5 U.S. tech stocks instead of 1. You're the exit liquidity. You're the bag holder. You're the one left standing when the music stops. This is the escalation loop most people won't see until it's already crushing them. Capital flight creates selling pressure. Selling pressure weakens prices. Weak prices spook more investors. More spooked investors create more capital flight. It feeds on itself. It accelerates. And by the time mainstream media explains what's happening, the damage is already done. Look at what happened in the UK in 2022. The government announced unfunded tax cuts. The pound collapsed. Pension funds started blowing up because they were over-leveraged. The Bank of England had to step in with emergency bond purchases just to prevent a systemic meltdown. That entire crisis happened in 2 weeks, from announcement to emergency intervention in 14 days. Why? Because once capital starts fleeing, it doesn't stop. It accelerates until something breaks. The United States isn't the UK. The dollar is the global reserve currency. The US has the deepest capital markets in the world. The US has the military, the technology, the innovation ecosystem, all true. But none of that makes the dollar immune to capital flight. In fact, it makes it more vulnerable, because the dollar's reserve status depends entirely on confidence, on the belief that US assets are safe, liquid, and stable. The moment that belief cracks, the entire structure becomes fragile. And BlackRock's $2 trillion move is a crack, a visible, measurable crack in the foundation of dollar confidence. But here's where it gets darker. This isn't just about stocks. This is about power. BlackRock isn't just an asset manager. They're a kingmaker. They control votes in shareholder meetings. They influence corporate boards. They shape policy through sheer financial weight. When BlackRock owns 7% of every major company in the S&P 500, they don't just have money. They have control. They decide who becomes CEO. They decide corporate strategy. They decide whether companies prioritize shareholders or stakeholders, profits or politics. And when BlackRock moves $2 trillion out of the United States, they're not just rebalancing portfolios. They're sending a message, a signal, a warning shot. They're telling the market that American exceptionalism is over, that the era of dollar dominance is ending, that the next generation of wealth creation is happening somewhere else. This is a power play disguised as portfolio management, and the implications go far beyond quarterly returns. Think about what happens if this continues, if foreign capital keeps leaving, if the dollar keeps weakening, if U.S. asset prices keep lagging international markets. Companies start raising capital abroad instead of in New York. Entrepreneurs build businesses in Singapore instead of San Francisco. Talent migrates to Dubai instead of Manhattan. The entire gravitational center of global capitalism shifts eastward. We've seen this movie before. London was the financial capital of the world for 200 years. Then World War I happened. The pound collapsed. Capital fled. And by 1950, New York had taken over. The transition took 30 years, but it was irreversible. Now the same forces are building again. The only question is timing. Does this happen over decades, or does it happen in years? BlackRock's $2 trillion move suggests they think it's happening faster than anyone expected. Now you might be thinking, okay, but where did the money go? That's the right question. Because capital doesn't vanish, it relocates. The answer is emerging markets, specifically China, India, Brazil, Taiwan, South Korea. The answer is Japan, which just went through a massive structural reset and is now delivering returns that haven't been seen since the 1980s. Let me break down the numbers because this is where most people get lost in the noise. Last year, the Vanguard Emerging Markets ETF returned 25%. The iShares MSCI Japan ETF returned 26%. The iShares MSCI EF ETF, which tracks developed markets outside North America, returned 34%. Compare that to the S&P 500's 16%, and you start to see the gap. A 10% to 18% performance difference might not sound like much, but when you're managing $10 trillion, that gap represents $1 trillion to $1.8 trillion in lost returns. BlackRock's clients don't accept underperformance. Pension funds don't accept underperformance. Sovereign wealth funds don't accept underperformance. If BlackRock keeps capital parked in underperforming markets, clients leave. They move their money to managers who deliver better returns. So BlackRock moved first, before the performance gap became undeniable, before clients started asking uncomfortable questions, before the exodus became forced. But it's not just about returns, it's about currency. And this is the part that destroys most retail investors because they don't understand how currency risk works. When you invest in foreign stocks, you're making two bets. You're betting that the stock goes up, and you're betting on the currency exchange rate. If the foreign currency strengthens against the dollar, you win twice. You get the stock appreciation plus the currency appreciation. Last year, the Japanese yen strengthened 8% against the dollar. If you owned Japanese stocks, you didn't just get the 26% equity return, you got an additional 8% from the currency move. That's a 34% total return. Meanwhile, if you owned US stocks, you got 16%. And because the dollar weakened against most major currencies, your real purchasing power internationally actually declined. This is the hidden wealth transfer that nobody talks about. Your portfolio might show a positive return in dollar terms. But if the dollar is weakening, you're actually losing wealth in real terms. Your buying power for foreign goods, for international assets, for commodities priced in other currencies, all of that is shrinking. BlackRock understands this. They're not just chasing returns, they're preserving purchasing power. And right now, the best way to preserve purchasing power is to get out of the dollar. The answer is also gold, physical gold. Not gold stocks, not gold ETFs, actual metal. Because recently, gold was reclassified by the Basel III banking regulations as a Tier 1 asset. That means banks can now hold gold on their balance sheets as if it were cash. Do you understand what that means? For decades, gold was dead weight, a relic, a shiny rock that didn't generate yield. But now it's liquid. It's collateral. It's leverage. Banks can now use gold to borrow money. They can use it to expand their balance sheets. They can use it as reserve capital instead of holding low-yielding treasury bonds. This changes everything. And when the biggest banks in the world realize they can use gold to print more money, to expand their lending capacity, to multiply their leverage, what do you think happens? They buy, aggressively, relentlessly, without hesitation. That's why gold is at all-time highs. That's why central banks globally have been net buyers for 14 consecutive quarters. That's why the metal keeps climbing even as real interest rates rise. It's not fear, it's utility. Gold just became useful again. And BlackRock knows this. They're not buying gold because they're scared. They're buying gold because it's now a functional asset in the new financial architecture. Central banks are buying thousands of tons. China added over 200 tons to its reserves last year. Russia, India, Turkey, Poland, Singapore, all net buyers. They're diversifying away from dollars and into gold because they see what's coming. Currency instability, inflation persistence, geopolitical fragmentation, a world where the dollar's dominance is no longer guaranteed, and if central banks are preparing for that world, maybe you should be too. This brings us to the final piece, the part nobody wants to say out loud. This $2 trillion move isn't the end, it's the beginning. Because if BlackRock is right, if the dollar continues weakening, if US growth continues lagging, if political chaos continues escalating, then this rotation accelerates. $2 trillion becomes $4 trillion. $4 trillion becomes $8 trillion. And at some point, the selling pressure becomes self-fulfilling. The exodus creates the crisis it was trying to avoid. The dollar weakens further. Foreign capital flees faster. Asset prices collapse. Volatility spikes. Credit freezes. And suddenly, the slow bleed becomes a hemorrhage. This is the nightmare scenario that keeps central bankers awake at night. Not a crash, a flight. A loss of confidence so deep that money simply leaves and never comes back. We've seen this before. We saw it in the UK in the 1970s. The pound sterling was the world's reserve currency for over a century. Then inflation hit, strikes paralyzed the economy, capital fled, and within a generation, the pound was a regional currency, no longer relevant on the global stage. We saw it in Japan in the 1990s. After the asset bubble burst, foreign investors pulled capital out and never came back. 3 decades later, Japan still hasn't recovered. The Nikkei index took 34 years just to reach its 1989 highs again. We saw it in Russia in the 1990s. Hyperinflation destroyed the ruble. Capital flight was so severe that the entire banking system collapsed. Savings were wiped out. An entire generation lost their wealth overnight. Every empire that loses reserve currency status goes through this. The only question is speed. Does it happen over decades, or does it happen in months? BlackRock's $2 trillion move suggests they think it's happening faster than anyone expected. Now here's what you need to understand about timing. Most investors wait. They wait for clarity. They wait for confirmation. They wait for the all-clear signal that tells them it's safe to move. But clarity is the most expensive thing in the world. By the time the picture becomes clear, the returns are gone. The opportunity has closed. The smart money has already moved. Think about March 2020. When COVID hit and markets crashed, retail investors panicked and sold. Institutions bought. 6 months later, the S&P 500 was back at all-time highs. The people who sold in panic missed the entire recovery. The people who bought in chaos made fortunes. BlackRock doesn't wait for clarity. They act on probability. They move on data. They position before the trend becomes obvious. And that's the edge. That's the only edge retail investors have. Not prediction, pattern recognition, not guessing, following. Watch where the big money goes. Watch what they buy. Watch what they sell, because they're not smarter than you. They're just faster. They see the signals first. So what do you do with this information? Do you panic? Do you sell everything? Do you abandon US stocks and go all in on emerging markets? No, absolutely not. Panic is how retail investors lose money. Fear is how wealth transfers from your pocket to theirs. You don't react. You reposition. Slowly, methodically, strategically. You don't abandon the US. You reduce exposure. You trim positions. You take profits on overvalued sectors and rotate into undervalued markets. You don't chase foreign stocks blindly. You use diversified instruments, broad-based ETFs that spread risk across multiple countries, multiple currencies, multiple economic systems. You don't bet everything on gold. You allocate 5%, 10%, enough to protect purchasing power if the dollar continues weakening, but not so much that you're crushed if it rebounds. This isn't about fear. It's about awareness. It's about recognizing that the world is changing and positioning yourself accordingly. But here's the trap. The biggest mistake 90% of investors make during a rotation like this. They wait too long, they hesitate, they second guess, and by the time they act, the move is already over. Right now, we're in the early phase. The shift is happening, but it's not obvious yet. BlackRock moved. Other institutions are starting to follow, but the crowd hasn't panicked. The headlines haven't turned apocalyptic. The CNBC anchors aren't screaming about capital flight. That means there's still time. Not much, but some. The window to reposition is open. It won't stay open forever. Once the herd realizes what's happening, once the capital flight becomes undeniable, once the headlines catch up to reality, the window slams shut, prices gap, liquidity dries up, the assets you wanted to buy become unobtainable at reasonable prices, and you're stuck holding depreciating dollars in a depreciating market. This is where fortunes are made or lost, not in the crash, in the rotation, in the quiet period before the storm when smart money moves and dumb money sleeps. Think about the people who bought real estate in 2010 after the housing crash. Everyone said they were crazy. The market was dead, prices would never recover, but they bought anyway, and within 5 years they doubled their money. Think about the people who bought Bitcoin in 2015 when it was $200. Everyone said it was a scam. A Ponzi scheme, worthless digital tokens, but they bought anyway. And within 2 years, they made 100x returns. The pattern is always the same. Smart money moves early, dumb money moves late, and by the time the opportunity becomes obvious, it's already gone. So ask yourself, are you positioned? Are you diversified? Are you protected? Or are you still holding the same portfolio you had 5 years ago, assuming that nothing ever changes, that America always wins, that the dollar will always be king? Because if you're still assuming that, if you're still operating on old rules in a new game, then you're not invested. You're exposed. And exposure in a currency crisis isn't risk. It's guaranteed loss. BlackRock moved $2 trillion. They didn't do it for fun. They didn't do it on a hunch. They did it because the math changed, the probabilities shifted, the risk-reward calculus tilted. And if the largest, most sophisticated, most well-resourced asset manager on earth thinks the U.S. is overexposed, maybe, just maybe, you should pay attention. This isn't the crash. This is the warning, the evacuation order before the storm hits shore. Most people will ignore it. Most people will rationalize it away. Most people will convince themselves that everything is fine, that this time is different, that the rules don't apply to them. And most people will lose. But you don't have to be most people. You can be the one who sees it coming, the one who moves early, the one who positions before the panic. The great transfer has begun. The only question is which side you'll be on when it's over.